Hi everybody, this is Oren again, coming back to part 2 of our introduction to the financial markets. In this section, we're going to talk about the investments and interest. And as a matter of fact, the majority of us have no clue what is really the real meaning of interest and what is investments, or what do I need to know, the core basics before I even go into an investment or understand, okay, I have 50 euros in my account, what should I invest it to, or 50 million or 50,000 or 500,000, it doesn't really matter. So that's number one. Number two, interest. Usually until we go to the bank, we don't even have a clue what is interest, and that's really important to understand. So this is what I'm going to do right now. I'm going to show you exactly how is this going to work, what are the basics, and let's take it from there. I'm going to introduce you to a very nice thing. So guys, our next topic is investment. So what should we know about investments? Of course, that investments will appear in different ways, okay, in different forms. So you also need to remember about investments that they are being affected by multiple things at the same time. Unlike the market core principles, which in general, like it's in its most natural form, it has two parties, two sides, buyers and sellers. Investments are different. There are multi effects that will make them good, bad, so on and so forth. And it has a price tag. And the price tag usually is what we talk about if it's tax or interest or negative interest, in our case, collaterals and other fees and requirements. Investment is not a game. Don't think that you have 100,000 euros and you can just invest them. By the time that it will be literally invested, you might need to spend a little bit more money before it will be totally invested in it. And one of the most important, the most important thing that people are forgetting when it comes to investments, it's a very simple term, which we know, the return on investment capital. I've invested 100K. What will be my return on investment? Will it be 1 million? Good. So I made 9,000, but I got back 1 million. Sorry, 900,000, but I got back 1 million. So those are the main things before you approach an investment. And I chose to go with interest and not to talk about taxation, collaterals, and return on investments, because let's start understanding the most basic core things when it comes to money. So if we're talking about money, okay, money has something that is fully correlated with them, which we call time. We all know what's the time right now, and what's the time in an hour or in 30 minutes, everything. But money doesn't know how much is it going to be worth, or what's going to be the value of money a year from now, 10 years from now. That is why we ask ourselves the question, what is the value of time? And the value of time in the economic markets is the interest. And if you ask yourself, what do you mean by there is a value for time, or why is there a value for time? Well, in a very simple example, I'll put it like this. There is a difference between owning 100,000 euros today and 100,000 euro in 5 years. The reason is because there are two values for what we call capitals, okay, which are nominal and realistic values. And again, I'm not going to go into this. This is a big discussion, which we will have to do a separate webinar for that. And this is more concerning us when it comes to loans, mortgages, so on and so forth. But think about what I'm saying. If I'm holding 100,000 euros today, time goes by, inflation, the strength of the market, the strength of the local currency, and so on, and the wheels of the markets and the economy are running. Then you're going to ask yourself, okay, can I buy the same things with this 100,000 euros, which I'm holding? Today I can buy a house. Tomorrow inflation may come and I cannot even buy an apple. Now you understand what is the true value of time when it comes to economics. So basically we use interest as the exchange rate of time. And this helps us understand what is the future value of our funds today. or our capitals today. All right. So what are the usages of interest and its effects? Unfortunately, the most common one we know are, yes, ladies and gentlemen, our beloved terminology, the term of loans and mortgage. Oh my God. Yes, this is what I like to call bad interest. So, of course, every time we borrow money from people, they expect us to pay them back from banks, from financial institutions. It doesn't really matter. And in that case, we understand that the mortgages and the loans, for the time that I was holding my money, my borrowed money, I will have to pay for that. That's like a fee. If we're talking about savings and deposits, positive interest. So, okay, I have some money saved up. I don't want to touch it. Let's say I won the lottery. I have now 100 million mega ball, whatever, earnings and profits, which I had. I put them in the bank, and the bank tells me, hey, buddy, leave the money here. We'll take care of it, and we'll pay you X amount of money per month or per year. Okay, we also use it as a main component in the monetary policy. Monetary policy is the policy that is being given to us and dictated to us by the federal bank or the local governmental bank. So the interest is a tool, which we will talk about in 2 minutes, for the local government, the local economists to play and control the markets. So if you want to know what does it do, the interest, it affects foreign investors. It affects the amount of money that the public is holding. We will talk about it again, all of it. It helps control demands, and it helps control inflation levels. All right, let's continue. So now that we understand that investments are something that you first of all need to understand, the return on investment capital, and okay, I have 100,000. By the time that I will literally be able to invest it, I will have to pay this person and that person and this paper and this government agency, blah, blah, blah. Okay, then we ask ourselves, we added the term interest, to understand what is the true value of my money today or over time. Now we need to introduce the money market and the interest. And you guys don't know it, but every month on the economic calendar, there is a monetary policy. Interest rates usually happens, if I'm not mistaken, in the middle of the month, each country. And this is what we call a major economic event. That's like changing the rate, like Mr. Mario Draghi, the chairman of the European Central Bank, which is literally about to leave. So now you all know when did I recorded this. So anyway, he just wanted to change the interest rates. And there was a big fuss about it because when you change the interest rates, it affects so many things. Let's go. So the money market. The money market is a display of the interest rates and the amount of money held by the public. How are those two things correlated? Let's talk a little bit about graph display. So going back to our y-axis, that in this case represents the interest rates, percentages. The interest rate is 1.2%. You've probably heard it about over the news. Then we have our x-axis, which represents the quantity of money held by the public in a market. Then we have the MD. MD is the money demand, which represents all of the people which are looking for money. Now you can see something very interesting. Our supply, money supply, is not a linear line. It's a horizontal line. Okay, it's a vertical line, sorry. Right? How can that be? This is what you call an unflexible supply, which means that the supplier, in this case, the government or the federal bank, they don't have, let's say, manufactural costs. Okay, so they decide on a specific rate, which will provide them with a specific quantity to have in the market. Thus, they control the amount of money in the public. So if we move forward a little bit, we'll get to the market balance point. Then we'll be able to know, obviously, the interest rates and we'll have the quantities. And then you ask yourself about the behavior, about what affects us, what doesn't affect us, what does it do? Because a second ago I showed you this graph, and we are all asking, man, what do you mean like the supply is vertical and this is this, that? Let me explain. So if we're talking about effects and behavior, okay, we need to understand what happens when the interest rate changes and who does it affect. First guideline, when the interest rates are low, think about what I'm about to say, close to zero, okay, less money is kept in the banks, which makes a lot of sense. I have 100,000, let's say I have $100 million. If I put this money in the bank, I'm getting literally close to nothing because the interest rate is so low that it's almost zero. So I rather just take this money out of the bank and maybe invest it in a restaurant, maybe buy a house, maybe buy a car, but I'm not going to keep it in the bank. So I'm going to take out this money and withdraw it. And then it means that there's more cash, more money, more spending, more purchases going on in the public, in the economy. And there's more movements coming in. So this is what we call a healthy market. Because if the banks are giving you nothing for you putting your money inside of it, like you get nothing for it, I'm not going to put it here. I'm going to put it under the mattress. Yeah, I'm going to buy a car. I'm going to buy a house. I'm going to buy a neighborhood. And then people are buying because they're holding money. And that's another natural behavior of people. When they have money in their hands, they buy, they use it, they consume it. And the demands and the volumes and transactions in the markets are increasing. And then people say, what is going on in this economy? Maybe I should take my money from another country, foreign investments, and put it here and open a restaurant or a hotel. Look at this economy. It's crazy. On the other hand, when the interest rates are high, more money is kept in the banks. Because let's say that the percentages of the interest rates are 25% in comparison to low, which was about zero. I have $100 million right now. I put it in the bank. I get 25% per year. That's like crazy. That's a business. Just take it. You couldn't find any alternative for your money. You'd rather keep it in the bank. So the higher the interest rates are, the more money we have in the bank, less people are withdrawing their money. There's less cash in the public, less transactions. This is what you call a dormant market. Less foreign investments coming in inside, okay, into the market itself. If we look at this, and we understand now that low interest rates, more money in the public, more transaction, people are spending, foreign investments, higher interest rates, I will say less activity, less everything, less quantity of money in the market. And this is what you can see here, that on the first point, which is the balance point 0, we moved our interest rate higher. That means that I move to market money supply number 1. I have a higher interest rate, less money in the public, and I just in somewhat prove my theory. To summarize everything, so we understood so far that there's a few important things in financial markets, right? We said that there's two sides of the mattress. There's buyers and sellers in the market. And even in the money market, in the interest market, we have the same thing, as you just saw. There's a supplier and there's a demandor, okay? I don't know how to name them, but there's a demand, okay? And in the interest market, we know that the interest is an indicator of value of time. It affects both local economy and its people, and interest rates affects investment into the market itself. Now, before we finalize this part 2 of our online webinar, Introduction to the Markets, I just want to remind everybody, investments are important. Just think about the information I gave you right now. And I mentioned that that right now, in order for you to invest, you need to think about, okay, all right, painting the tape. I saw the video. I saw the webinar. They said, your investments, first of all, you have X amount of money. By the time that I take this money and move it to my investment place, like I literally buy something or invest into something, what is the amount of money that we have? Okay, so there's taxes, there's fees, there's lawyers, stuff like that. Then what is the return on investment? What is the time frame for all of this to happen? This is in general the investment, and investments are being affected also by the interest rates and the money market. And this is something I want you to know because it's really important. People don't know it. So before you go on and you make your investment, think about what are the alternative you have. And in our next episode, in our online webinar, Introduction to the Financial Markets, part 3, I'm going to show you right now the ultimate table for you to maybe start taking decisions in a different way. All right, boys and girls, thank you very much. See you at part 3.